Welcome back to We Are Cosmic, the channel where we break down crypto, finance, and global money systems in a simple and powerful way. If you care about the future of banking, digital assets, and where XRP fits into all of this, you are in the right place. Today's discussion is serious. We are not just talking about price, we are talking about infrastructure, we are talking about power, and we are talking about whether XRP is being positioned as the invisible engine of the next financial system. There is a bold claim circulating that President Donald Trump has chosen Ripple for a 21st century banking upgrade. Now, before we get emotional or overly excited, we need to approach this like professionals. In crypto, narratives move markets, but facts build wealth. So today we separate speculation from strategy. The core idea being shared is this: Ripple and the XRP ledger are not meant to be consumer-facing brands. They are not trying to compete with your bank's mobile app. Instead, they are being positioned as underlying infrastructure, the plumbing behind global payments. According to claims referenced by Lord Belgrave, there were confidential intergovernmental briefings across European states discussing standardized cross-border settlement rails. These rails would be invisible to users, banks would still present their own brand, customers would still see their trusted institution, but underneath, the system would be interoperable, real-time, and neutral. This concept is extremely important. Institutions do not sell infrastructure, they sell services. The rails simply need to work. When you send money internationally today, you do not see SWIFT. You see your bank's logo. That same logic could apply to XRP. Now let's be clear, there is no official public confirmation that President Trump has formally selected Ripple or XRP as national infrastructure. That part remains speculation. However, we do know something important. Ripple consistently appears in high-level regulatory discussions. They have been invited to policy meetings in the US and internationally. That is not random. When governments begin shaping crypto regulation, they invite projects that are serious, compliant, and scalable. Ripple has positioned itself as a regulatory-first company. They are not anti-bank. In fact, CEO Brad Garlinghouse has repeatedly said Ripple does not want to replace banks. They want to upgrade them. This is a very different strategy compared to early crypto ideology. Bitcoin aimed to remove banks. Ripple aims to integrate with them. Think about that carefully. If XRP becomes embedded infrastructure, most users may never even know they are using it. Payments would settle faster. Costs would drop, liquidity would improve, but the XRP brand might remain invisible to the average person. From an institutional design perspective, that is actually ideal. This is how major systems evolve. TCP/IP powers the internet, but most people do not know what it is. SWIFT powers global bank messaging, but most customers have never heard of it. If XRP follows this path, it becomes utility, not hype. Now here is the bigger question. Why would governments consider upgrading financial rails at all? Because the current system is outdated. Cross-border transfers are slow. Liquidity is trapped in Nostro and Vostro accounts. Settlement can take days. And in a 24/7 digital economy, that inefficiency is expensive. When Trump talks about upgrading financial infrastructure, it aligns with a broader global theme. The world is digitizing money. Central banks are experimenting with digital currencies. Tokenization is growing. Real-world assets are moving on-chain. If a Clarity Act or similar regulation formally classifies XRP as a digital commodity alongside Bitcoin and Ethereum, that removes a major institutional barrier. Legal clarity reduces risk. Reduced risk invites capital. But remember, regulation alone does not guarantee price appreciation. Utility, liquidity depth, and adoption matter. So in this series, we are going to analyze three major layers. First, infrastructure positioning. Second, regulatory clarity and institutional access. Third, real-world utility and liquidity expansion. Because hype without structure is dangerous. We evaluate probability, and we focus on long-term positioning, not short-term emotion. If XRP truly becomes invisible infrastructure, the biggest gains will not come from marketing. They will come from integration. Now let's go deeper into the European angle because this is where the story becomes more technical and more interesting. There are reports circulating that XRP, Algorand, and Stellar have been verified or recognized as compatible rails within what is being described as a European unified ledger. The idea behind this ledger is not small. It is about modernizing Europe's settlement infrastructure. To understand why this matters, we need to understand what Europe currently uses. Europe operates systems like Target 2 and T2S, Target 2 securities, which handle large-scale interbank payments and security settlement. These systems work, but they are traditional. They are not built for 24/7 programmable digital asset settlement. They were designed for an older financial era. Now imagine upgrading that system to a distributed ledger technology, DLT environment that runs continuously, supports tokenized assets, and allows programmable money. That is the concept behind the European shared ledger idea, something aligned with conversations happening at the European Central Bank. The ECB has openly discussed digital euro experiments and interoperable DLT frameworks to support tokenized assets. Conceptually, the goal is simple: bring central bank money, commercial bank money, tokenized securities, and digital assets into one programmable financial layer. That is a massive shift. If XRP is technically verified or recognized as compatible infrastructure in pilot programs or interoperability frameworks, that does not mean it won, but it does mean it is in the room, and being in the room matters. Financial infrastructure upgrades are not decided overnight. They go through pilot phases, sandbox testing, interoperability checks, and compliance reviews. If a blockchain is technically compatible and regulatory friendly, it becomes an option. Now think about Ripple's design philosophy. Ripple has always focused on cross-border payments, liquidity efficiency, and regulatory compliance. The XRP ledger is fast, low cost, and built for settlement efficiency. It was not built for meme culture. It was built for throughput. That aligns well with institutional needs. But here is where we must stay disciplined as analysts. Being referenced in a briefing or being technically verified does not mean full-scale adoption is guaranteed. Governments test multiple technologies. They compare performance, scalability, compliance, and geopolitical considerations. However, there's a clear pattern globally. Central banks and regulators are moving toward tokenization and programmable finance. And when we talk about tokenization, we are talking about real-world assets becoming digital representations on-chain. That includes bonds, securities, real estate, and even central bank money. If Europe builds a shared DLT layer that supports these assets, the question becomes, which settlement rails are deep, liquid, neutral, and globally interoperable? That is where XRP's positioning becomes interesting. Unlike purely decentralized ideological projects, Ripple has built enterprise relationships for over a decade. They understand compliance, they understand banking language, they understand settlement needs. Now let's add another layer to this discussion. As Europe explores digital euro frameworks, and as other regions explore CBDCs, interoperability becomes critical. Digital silos do not solve global finance. You need bridges. XRP was literally designed as a bridge asset. That does not guarantee it becomes the bridge, but structurally, it fits the use case. So when we hear claims that XRP, Algorand, and Stellar are compatible or verified within European DLT frameworks, the key takeaway is not hype. The key takeaway is positioning. Positioning inside policy discussions is more important than retail marketing campaigns. In finance, infrastructure decisions take years, but when they are finalized, they tend to stick for decades. And if XRP becomes part of even a portion of that infrastructure, the long-term implications are much larger than short-term price movements. But infrastructure alone is not enough. Infrastructure is powerful, but infrastructure without liquidity is useless. If banks are going to move billions of dollars instantly, the underlying asset must be deep, stable, and efficient. That is where stablecoins and auto-bridging mechanisms become critical. Recently, we have seen expansion of multiple stablecoins on the XRP ledger. This is not just one region or one currency. We are talking about dollar-backed, euro-backed, and even Brazilian real-backed stablecoins launching within the ecosystem. For example, Ripple introduced RLUSD, its own regulated stablecoin. Brazilian institutions like Brasa Bank have issued USDB and BBRL. European euro stablecoins are also emerging within this network. This creates something very important: multi-currency liquidity pools operating on the same ledger. Why does that matter? Because cross-border payments are expensive mainly due to currency conversion and trapped liquidity. Banks today must hold funds in different jurisdictions to settle international transfers. This ties up capital. The XRP ledger's auto-bridging system allows XRP to act as an intermediate bridge between two currencies. For example, if someone wants to convert euros into Brazilian reals, instead of relying on a direct trading pair, the system can automatically route euro, XRP, BRL if that path is more liquid and efficient. This process happens almost instantly and at low cost. That is not theory. That is a structural design feature of the ledger. If stablecoins expand across regions, and if they are regulated and institutionally backed, then XRP's role as a bridge asset becomes more meaningful. It increases transaction pathways. It increases network utility. Now let's be realistic. Payments and remittances are not fully solved yet. Cross-border transactions still face regulatory friction, compliance checks, and liquidity bottlenecks. But stablecoins are currently the strongest candidate to fix this problem. They combine blockchain efficiency with price stability. And when stablecoins operate on a ledger where XRP can bridge liquidity automatically, you create an efficient foreign exchange layer. From an institutional perspective, this is attractive. Banks do not want volatility. They want efficiency. If XRP can serve as a temporary bridge for milliseconds while stablecoins represent fiat value, that reduces exposure risk. Now think bigger. If RLUSD evolves beyond simple payments and begins offering yield through tokenized real-world assets, such as private credit or tokenized U.S. treasuries, the XRP ledger becomes more than a payment rail. It becomes a regulated financial marketplace. There are already developments like Soil launching real-world asset yield protocols funded by RLUSD, offering fixed returns backed by traditional financial instruments. This is a major shift. It means stablecoins on XRPL are not just transactional tools, they are capital allocation tools. For institutions, yield matters more than ideology. If a bank can hold a regulated stablecoin, earn fixed income yield, and access instant liquidity, all on one ledger, that is powerful. This is where many retail investors underestimate the ecosystem. They focus only on XRP price targets, but price appreciation requires liquidity depth and real usage. Let's talk about liquidity depth for a moment. If XRP were priced at $1 and a bank wanted to settle $1 billion instantly, that would require enormous volume and could cause heavy slippage. But at higher price levels, say $20 or above, the market cap and liquidity pool become thick enough to absorb larger transactions smoothly. In simple terms, higher price can actually support institutional use if liquidity scales accordingly. That is why discussions around regulatory clarity and classification matter. If XRP is treated as a commodity similar to Bitcoin and Ethereum, institutional allocators who were previously restricted could enter the market. Regulation removes uncertainty. Liquidity follows certainty. But remember, adoption happens gradually. Pilots become limited integrations. Limited integrations become broader deployments. The expansion of stablecoins, the growth of auto-bridging, and the emergence of yield products show that the XRP ledger is evolving beyond narrative. It is moving toward layered utility, payments, liquidity, yield, and tokenization. And that brings us to the next big development, real-world asset tokenization and what it signals globally. Now we reach one of the most exciting layers of this story, real-world asset, RWA tokenization on the XRP ledger. This is where the narrative shifts from theory and liquidity to tangible value being represented on-chain. Recently, we've seen high-profile pilot projects using the XRP ledger for tokenized real estate. A notable example is the Dubai Land Department, which completed a Phase 2 launch of its real estate tokenization initiative. Initially, the pilot tokenized around $5 million worth of properties. Now, with Phase 2, approximately $7.8 million in property tokens are tradable on a controlled secondary market. Some might say $7.8 million isn't huge. That's true in absolute terms. But consider the context. Every major innovation starts small. Pilot projects validate technology, regulatory compliance, and market interest. Dubai is effectively proving that XRPL can handle regulated asset trading, a critical step for institutional adoption. What makes this even more powerful is the combination of XRP as a bridge currency and RLUSD as a stablecoin. Real-world assets can be tokenized and instantly traded or settled using the XRP ledger's efficient rails. The potential applications extend far beyond Dubai. Imagine tokenized real estate in Europe, Asia, or the US, all settled instantly across borders, fully compliant with local regulations. Another significant development is Soil, a protocol introducing real-world asset-backed yield on RLUSD. Here, XRP's ecosystem is moving from simple transactional utility to a multi-layered financial platform. Banks and institutional funds can now park capital in regulated stablecoins that earn fixed yields backed by tokenized credit or treasuries. Within 72 hours of the initial vault opening, 1 million in assets was deployed, signaling real demand from institutions, not retail hype. This is crucial because it demonstrates a key principle: utility drives value. When XRPL becomes a platform for regulated yield, tokenized real-world assets, and cross-border liquidity simultaneously, XRP's role is no longer speculative. It is functional. Think of it like this. Most cryptocurrencies are evaluated solely on market cap and price momentum. XRP is moving differently. Its value proposition is operational. Banks and institutions care about settlement speed, liquidity efficiency, cross-border interoperability, and compliance. XRP is building all of these. Now, what does this mean for retail investors and crypto enthusiasts? First, tokenization of real assets introduces more transparency and accessibility into traditionally illiquid markets. You no longer need millions to participate in commercial real estate or high-grade credit. Tokenization fractionalizes it. Second, the combination of XRP's bridge utility, regulated stablecoins, and real-world asset yields creates a self-reinforcing ecosystem. Liquidity begets adoption, adoption increases usage, and usage strengthens credibility with regulators and institutions. Third, and perhaps most importantly, XRP is quietly building a layered financial infrastructure. Payments, liquidity, stablecoins, real-world asset tokenization, yield protocols. Each layer adds depth and legitimacy. This is exactly what institutional investors look for: a safe, efficient, and scalable system that can integrate with existing financial networks. Finally, this development ties back to the narrative of invisible infrastructure. The average consumer might never know they are interacting with XRP or RLUSD. They simply experience faster payments, easier cross-border transfers, or accessible real-world asset investment. But for those analyzing institutional trends, these developments are clear indicators of XRP's growing footprint in the global financial system. In short, real-world asset tokenization is no longer a hypothetical use case. It is actively happening. It validates XRPL's capability to serve as more than a payment rail, as a multi-purpose platform that can safely, efficiently, and compliantly handle institutional-grade financial operations. Now that we've covered infrastructure, stablecoins, and real-world asset tokenization, it's time to focus on regulation, a critical factor for XRP's institutional adoption and price potential. For years, XRP has been trapped under regulatory uncertainty. The lack of clear classification meant that many U.S. banks, funds, and institutional allocators could not touch it. Regulatory risk suppresses demand. It's that simple. Without certainty, capital stays on the sidelines. Enter the proposed Clarity Act, expected to codify XRP as a digital commodity on par with Bitcoin and Ethereum. This is a potential game changer. If passed, XRP would shed the regulatory risk premium that has held it back. For institutions, clarity equals confidence. For XRP, confidence equals demand. Let's break this down. Analysts are looking at three major pricing scenarios. Classification rally, $5, $10. This is based on the idea that regulatory clarity alone could unlock institutional access. Once XRP is legally recognized as a commodity, previously sidelined banks and funds can hold it. That alone could push the price into this range. Operational utility, $15, $30. This scenario assumes that XRP is fully integrated into U.S. domestic and international payment rails. Here, XRP's bridge functionality for banks, cross-border payments, and stablecoin liquidity becomes fully active. Institutional volume grows and the ledger sees real operational use. Peak potential, 100 plus, the most bullish case. If XRP becomes the backbone of the U.S. banking liquidity system, enabling multi-billion-dollar settlements seamlessly, then supply-demand dynamics could push the price significantly higher. This is contingent on widespread adoption, deep liquidity, and full regulatory certainty. Why do these scenarios matter? Because price is no longer just about speculation. It is tied to fundamental utility and adoption. XRP is not being built for short-term hype. It is being built for real-world financial integration. Another supporting factor comes from technical chart analysis. Long-term Fibonacci extensions point to natural resistance and support zones around $8, $13, and $27. While technicals don't guarantee outcomes, they provide a framework for understanding potential market behavior. Banks and institutional buyers often respect these levels when sizing positions and managing liquidity. Regulatory clarity also interacts with XRP's ecosystem in other ways. As more real-world assets are tokenized and stablecoins expand on the ledger, the demand for XRP as a bridge increases. Essentially, clarity plus adoption creates a feedback loop. Institutions buy XRP for liquidity, which strengthens the ledger's utility, which further attracts capital. We also need to consider global adoption. Dubai's real estate tokenization and Europe's unified ledger initiatives suggest that XRP is not just focused on the US market. It is building multi-jurisdictional relevance. Regulatory clarity in the US will make it easier for other regions to trust XRP-based systems. But here's a critical point. Price does not move in isolation. Timing, adoption, regulatory announcements, and macroeconomic factors all play a role. The market could anticipate positive regulation, or it could underreact initially. Either way, the trend is driven by fundamentals, not hype. So as we approach potential milestones like the Clarity Act or further institutional integrations, XRP is in a unique position. Unlike many cryptocurrencies, it is utility-driven, compliance-ready, and strategically positioned. Now we arrive at the final part of our breakdown. After analyzing infrastructure, stablecoins, real-world asset tokenization, and regulatory clarity, it's time to step back and look at the bigger picture. What could XRP truly become if all these pieces align? The narrative is clear. XRP is quietly positioning itself as invisible infrastructure for the next-generation financial system. Unlike consumer-facing apps or speculative tokens, XRP's value proposition lies in functionality and institutional adoption. It is designed to be embedded, abstracted, and taken for granted, just like Swift or TCP/IP. Most users may never know they are interacting with XRP, yet it could move trillions of dollars behind the scenes. Consider the layered ecosystem we've discussed. Infrastructure. Ripple and the XRP ledger are being referenced in high-level policy discussions and pilot projects globally, including Europe's unified ledger system. They are designed to serve as settlement rails for banks, central banks, and large institutions. Stablecoins and auto-bridging, multi-currency stablecoins on the XRPL combined with XRP acting as a liquidity bridge create fast, cost-efficient, and scalable cross-border payments. Real-world assets, tokenized properties, private credit, and treasuries are beginning to be traded on-chain, showing that XRPL can support regulated financial instruments with real value. Regulatory clarity. Potential U.S. legislation like the Clarity Act could officially classify XRP as a digital commodity, removing uncertainty and unlocking institutional capital. When all these layers come together, the result is a multi-purpose financial platform. Not just payments, not just crypto speculation, but a regulated institutional-grade system capable of moving money, settling assets, and providing yield globally. The implications are significant. Institutions care about efficiency, reliability, and regulatory compliance. If XRP delivers on all three, it could become the backbone of cross-border payments and tokenized finance. That would fundamentally shift how banks, governments, and investors interact with digital assets. From a retail perspective, it's important to understand that XRP's path is slow and deliberate. Adoption at the institutional level is measured in years, not weeks. But the upside is enormous. Once these systems are operational and widely adopted, the ledger's utility drives real demand, which can support meaningful price appreciation. Looking at hypothetical scenarios, a properly integrated and widely adopted XRP network could enable settlement of billions in real time, support multi-currency stablecoins, and provide regulated yield opportunities for institutional investors. Peak adoption could lead to a multi-billion-dollar ecosystem with XRP at its core, serving as the bridge currency for a global digital economy. The key takeaway is this: XRP is not just another token. It is a strategically designed financial tool, quietly building institutional trust, regulatory clarity, and technical infrastructure. Those who understand the layered potential may be looking at a unique combination of security, utility, and upside. As we continue to monitor developments, from European ledger pilots to U.S. regulatory milestones, real-world asset launches, and stablecoin adoption, we get a clearer picture of XRP's role in the evolving global financial system. And remember, this is about positioning for the next decade, not chasing the latest pump.